Eli Lilly. This has been an incredible stock, right? This is a big cap stock, $653 billion of market cap, 413% return to investors in 5 years. Very good. And if we go to the max, I mean, this thing's just been a really good wealth creator for investors. And the story here is this is a very well-run pharmaceutical company that has a variety of drugs, including a weight loss drug. The weight loss drug is really created the last push of growth, which is great, but they are a diversified pharmaceutical company. It's not just weight loss drugs that they're doing. They have current year PE of 78. It's going to drop to 32.5. And analysts believe it's discounted by 35%. They have a small dividend, and it is coming up. So we'll take a look at that. And let's take a look at some of their fundamentals, and then I'll do a valuation on Eli Lilly. The things to like about Eli Lilly is look at this growth. Just really good, solid growth. They did have a year where things kind of were flat, but now they're growing at 27%. So the company keeps growing. And sometimes, you know, some of these stories, like the story on Uber as an example is, oh, robotaxi is going to take away their business. That's really had an impact on the stock price, even though they keep growing. In the case of Eli Lilly, I think the story is that other pharmaceutical companies are developing their own recipes or formulations of a weight loss drug, and that they're coming to market with weight loss drugs. So the expectation is some of the revenue growth is going to stop for Eli Lilly due to competition. And that may happen, but it's just a story at this point. When we look at their profitability and free cash flow, so margins are phenomenal, 81%. That's great. Free cash flow is a little lower than I expected. I mean, these guys are doing almost $41 billion of revenue. And in the trailing 12 months, they're only getting 1.4 billion of free cash flow. That's way lower than I expected. So yeah, see, the free cash flow margin's been really low. I really like these numbers, 20%, 21%, 20%. But something has fallen. I wonder what's going on with the business that's causing the free cash flow to leave or to not exist. I'll take a look at the free cash flow statement and see where capital expenses and so forth. So this is a statement of cash flows. It starts with net income, and then you have all the cash adds and takeaways. And so the operating cash flow is a little lower. They were operating cash flow a full year ago was at 7.5 billion. It's at 6 billion now. And CapEx has really grown. This is where the cash is going. They're putting it back into the business currently. Okay, so I don't know if it's, hey, we're reconditioning production lines. We're putting more back into our factories. Research and development of exploring new drugs is not in this category. Research and development has to be expensed in the income statement. So this is all like factories getting new components and stuff. And Kiter, do you have a comment?
Yeah, I just wanted maybe to say that they are investing in building or acquiring a manufacturing facility in the US to manufacture the LGP-1 drug. They were saying that the demand is higher than what they can deliver, and they are investing in building up facility. This can be an explanation or the explanation to the big capex that you are seeing. That's one. Second, they announced or warned like last week that their next quarter, the sales of the LGP-1 will be a bit lower than projected or expected by analysts. So
Got it.
yeah, that's it.
So they guided down and they're putting more money into their production. The stock over the last, since August 30th, so I guess that's going to be about 4.5 months, is down about 24.4%. So the stock is trading lower than it was 4 months ago. Okay. Now going back to some of their fundamentals. So analysts think it's discounted. They're basing it on earnings per share. Let me take a look at a valuation of these guys. And what I'll do is open up another screen here on a monitor you can't see, so I can just look at the data and put it into my valuation model. Now these guys, I'm going to compare to Pfizer. I know Pfizer's somewhat in their industry. So let me go into this one. All right, so this is a good company. They have a good balance sheet, so 8% is fine. We'll look at growth in a bit. So I'm going to do an estimation for 2025. And Eli Lilly, on average, looking at 2022 and 2021, which were years when they did well, their free cash flow was 6 billion and then 5.7 billion. And before that, so I'm going to say, hey, you know, going forward, there's no reason why these guys can't get back to, I'm going to call it 6 billion in free cash flow. Because their business is bigger, they're growing their top line, they have terrific margins. I think the investment in capital expense is temporary. So we'll just, I'm having the expectation that they're going to return to 6 billion. They're growing the revenue by 20%. So I'm going to grow the first 4 years by 15%, growing that free cash flow. In 4 years, it'll be at around 9 billion. All right. So that gives us an intrinsic value at around 185 billion. Looking at their balance sheet, they have $3.5 billion of cash. And they have quite a bit of debt, 31,230 million. Wow. So we're not getting a very high valuation based on free cash flows. So this one here, what are their shares outstanding? Shares outstanding, 900 million shares. So I'm showing a big premium on the stock because, let's say I change this to 7. Well, I'm not going to change it to 7.5 because their balance sheet does have quite a bit of debt. So we'll just leave that alone for now. It's showing that it's actually priced at a premium because the cash flows are not very high. Their market cap's very high. 653 billion is a big market cap. Okay, so let's leave that alone for a bit and go over to earnings per share. 21 analysts cover this stock. They think it's 35% discounted. For 2025, it's expected they're going to do $22.74. I think a company that's a leader like this should be at least 25. I'd even go upwards of 36. And they're going to grow revenues. Looks like in 25, they're growing 28%. And 26, they're going to grow 20%, 27, 11%. And their earnings per share is going to expand even faster. It's going to expand by 71% in 2025, 32% in 2026. So expanded by 20%. So you can see that, yeah, I'm agreeing with analysts. Analysts say it's discounted by 35%. That's exactly what I'm getting, 35%. But I combine the two. I look at cash flows and then I look at earnings per share. And when I combine the two, it shows that it's being sold at a premium. Now let's compare it to one of its, industry peers, and that is Pfizer. Pfizer is going to do better cash flow and than Eli Lilly, but their market cap's much lower. So I like Pfizer. I think they're on a bounce back year, and I think they're going to do well this year. But that's just a comparison. I'm not trying to convince you to buy Pfizer, but the cash flow is a little low. That's why I haven't invested in Eli Lilly. Their earnings per share does substantiate the stock price. Okay. All right. So that's Eli Lilly. If they're guiding that they're not going to sell their weight loss drug as quickly as they had in the past, I think that's what's weighing on the stock. And for me, I get myself out of investing mode with Eli Lilly because they're cash flows. I have to stick to the recipe that works for me for finding good stocks. So that's Eli Lilly. It's not a buy for me. It's actually a pass because I can't get the valuation to be high enough. So Novo Nordisk is down for the year, down 26%, close to 27%. For the 5 year, it's up 156%, but it has dropped quite a bit from its peak. almost 45%. Now, looking at, so Novo Nordisk, let's take a look at their overall fundamentals. It's $195 billion market cap. Okay. Quite a bit smaller than Eli Lilly. Revenue, 49 billion. Very good. PE is really low, 11. Wow. Dividend looks good. And these guys, okay. Looking at their financials, they have good growth. Eli Lilly's growing faster. Eli Lilly was like 20% revenue growth.
Now you're back on Novartis now. Did you mean to be?
No, sorry. Let me close that so I don't confuse myself anymore. Thank you. So revenue growth is very good at 26%. And then we've got 31% on the full year 2023. So that's very good growth right there with Eli Lilly. So that looks really good. And now we'll look at free cash flow. And this is another currency, right? Yeah, DKK. Okay, so I'll convert that in a bit. This is free cash flow. Looks here. It looks like it's been growing. Very good. I like seeing good, smooth data because it gives me greater assurance or confidence and expecting it's going to continue to rise because that's what they've proven over the last 6 years, 7 years. All right, so that looks good. Gross margins are even better than Eli Lilly. That looks really good. Okay, so let's take a look at free cash flow. Statistics is going to, within the stock analysis website, converts the foreign currency to US dollar. So free cash flow is $10.7 billion, much higher than Eli Lilly. So that looks really good. So they're growing at the same rate, much more cash flow, higher dividend rate, 3%. So let's put this one into the valuation and see where this one goes. We're copying this one over. The free cash flow for the trailing 12 months is $10,700,000,000. So growing at 15%, maybe I'll grow it by 10%. And so these cash flows are worth a lot. And they've been consistent in growing them so that this feels a little more assured because of their performance. And it has a very, very good value, with regards to free cash flows. When we look at the balance sheet, they have a lot of cash, more cash than debt. They have $11,200,000,000 of cash. They can pay off debt immediately because debt's only $8,520,000,000. The shares outstanding for Novo Nordisk is 4.45 billion. Okay, so this looks better, but it's still not up to its value based on free cash flows. I could probably go a little higher on the growth rate here. Probably hit this with 10% growth. It's fine. Yeah, it's fairly priced. Looking at their cash flows, this is I would say, a conservative cash flow forecast. If we look at their cash flow growth in the past, so they've had years in the past where they, like 2020, they grew by 21%, 21 by 5.5%, 22, 37%. But their cash flow did come down a bit. So maybe we could go to like 15% for the first 4 years and then 4% for terminal. It's still going to be about fairly priced. Okay. So that's that. When we look at the forecast, only 5 analysts provide a price target. But the good news is they believe that stock's discounted by 70%. It's quite a discount. And when I look at earnings per share for 2025, it's expected to be $28.92. So 28.92. I'm gonna go with 25. Growth rate. They're supposed to grow cash flows by 20%, then 4%. So I'm gonna split the difference and go 12. And wow, this can't be right. Okay, that's because I'm in DK. Okay, that makes sense. So let me convert from DKK to USD is 0.14. All right, so it's 44% discounted if we look at the earnings per share method with a conservative PE of 25 and growth rate of 12%. So I think Novo Nordisk. So first question is, will weight loss drugs continue to work? I think they are. I think they're highly successful. They have momentum. I just hear that people are, liking the benefits and what they get out of them, and I imagine they're going to do just fine. So I expect that Novo Nordisk is going to do well as Eli Lilly. But if I were to compare the two, I'd have to go with Novo Nordisk because it provides a discount. If I look at the earnings per share method and the free cash flow method, both provide a good valuation on the stock. The other story that has impacted Novo Nordisk and Eli Lilly is that President Trump has brought Robert Kennedy onto his staff, and he's going to lead the department that is going to go oversee, I guess, pharmaceutical companies. And he has had some comments that are anti-weight loss. I don't know that that's going to be a big factor, frankly. I think that he may have expressed an opinion, but I think that they may just leave this space alone. It's a guess, and that's my guess, is that they're going to leave this space alone. Would be unpopular if people are getting benefits from these, pharmaceuticals. And if you took them away, boy, that'd be kind of a political price for anybody to pay. And I think if something's working and they're getting health benefits, just leave it alone is my expectation. But we'll see what happens there. Go ahead, Scott.
Okay, yeah. So I have just one comment, one question.
Mm-hmm.
One is, thanks to my Interactive Brokers account, something I noticed recently is for these companies based outside the US where they're listed on multiple exchanges. So like this is not their home exchange, right? They're actually listed in the Danish exchange as well.
Mm-hmm.
And so I looked up the fundamentals of their stock, and I have access to a lot more analyst ratings than you can see in typical sites. Like I think, for example, with Novo Nordisk, I actually have 26 ratings here. So I can send that to you if you like.
Also, what's the general opinion? Do they offer the average opinion is the price target's higher or lower? What are some of the conclusions?
For what it's worth, out of the 26 analyst ratings that they have, mostly it's from TipRanks, if you've heard of TipRanks, 18, I mean, they're from different banks, right? But that's just aggregator. 18 say buy, 7 hold, 1 sell. And the average target is about 40% higher of what it is now.
Yeah.
In the Danish kroner, which is their currency. So that's that. And also it's like for other companies as well, like I've definitely seen more for the UBS, for example, right? The Swiss company, or this Avolta company, right? Or any company where I can see it on look at the home exchange, basically, in the home country. So that's just one comment. And then I had a question about your analysis worksheet. And it's per EPS, and it's something that I'm trying to wrap my head around. So this intrinsic value, now just my educated layman's, I guess, intuition was that, okay, a lower PE should be better because you're getting a better deal. But your intrinsic value formula, it's the opposite. The intrinsic value actually goes up with a higher PE ratio. Is that right?
Yes.
You enter on the sheet. And could you explain that to me? I mean, I think I might know what it is, but if you could explain the logic of that to me, that would be good.
Sure.
Also, I guess where that PE is from. Like if you're using forecast PE or a trailing.
So when I put together this spreadsheet, right, or model, it's my investing tool. Okay. And I'm just going to stick to earnings per share, and I can go into the discounted free cash flows if you'd like, but just earnings per share. So the way that I use this is, what PE and growth rate am I willing to go with for this company? It's my decision. Now, the earnings per share that's expected, that's a little bit of the market's telling me that. All these analysts, based on forecast, they're saying, hey, it's going to be about $4.05 it's expected. Okay, now it's my decision on PE. I go with 25 because I like pharmaceutical and healthcare. I like that Novo Nordisk is growing. I love their margins. I love a lot of things there is to have in this stock. Now I'm going with a 25, not a 36 or a 48 which would be for a high growth company in a really hot space that's an expanding market, because that's what I'm willing to pay. I think it's a safe number. It's right there with the average in the S&P, and I'm willing to pay 25. Growth rate, I'm willing to say that that earnings per share is going to grow by 12%, because this is my money I'm investing. And based on those factors, I think the stock is worth $113 per share, which is close to what the analysts are saying on the site that you were referencing. So that's the PE comes from me. That's a decision I make as the investor. Does that answer your question, Scott?
Yeah, I think so. So just, I guess I would say qualitatively over quantitatively then, what you're saying is you
Both.
would put a higher PE, but yeah, so you would put a higher PE for a company that you think, like, if it's kind of like you would think that they have higher intrinsic value and a higher growth rate. So you would put a higher PE then.
Correct.
Which then leads to that quantitative result. Is that
Yeah, let's
more
say you have a company in a space that's really expanding. What do I mean by that? Let's say AI is pretty darn popular, right? And going back like 2 years, especially. So the AI space was expanding, meaning the amount of addressable market was expanding very fast. Like, hey, the data center and all these places are going to have more revenues available to the competitors in that industry. So that's a big plus. That's why I would move the PE up. A company's performance and expected growth rate, if a company is going to grow like NVIDIA, they're going to grow at 100, 150%. Wow, that's incredible. So the PE is going to go well above 25, like in this case here. It might be 100, it might be 120. It's difficult to predict, but you have to go up that higher because you have the combination of their marketplace is getting bigger. There's going to be more dollars to go around. And these guys are growing at 100, 150%. And they have margins of 80%. I mean, it's like the perfect storm for a stock to just go crazy. So that's where the PE would be super high. Why would its PE be super low? It's a very old industry that is actually not growing or contracting. Over time, the available dollars in that market are getting smaller for the players or the competitors in that market. That would be a lower PE with lower growth rates. So those should be value stocks that are discounted. When we look at, like, let's look at Chevron as an example. That's where PE of 12, because the oil industry has been around for more than 100 years. There's plenty of competitors. The market space is not expanding. It's not like, hey, we need 50% more oil. No, it's like on a given year, 1 year we need 2% more oil. The next year we dropped our demand by 1%. It's just a very static market. And that's why Chevron gets a 12. Great business, profitable. We know what we're getting there. But you look at a Novo Nordisk and it gets a 25. Their business is expanding. They're in a really interesting market with weight loss, which is expanding. And that's my explanation on PE.
Okay, thank you.
So this tool here, the spreadsheet, this is a tool that I use. And again, it's meant to be one of the primary steps of my decision to invest or not invest. And it's based on free cash flows and earnings per share. And I get to put in the data because I'm the one that's investing my dollars into this company. All right, perfect. So good. So the conclusion, a couple of conclusions on Novo Nordisk and Eli Lilly. I think the space is going to do well. But the story is going to probably stick around for a little while, which is potentially an opportunity. Out of the two, I like Novo Nordisk more than Eli Lilly. They pay a better dividend, so I get to cash in a little bit more of my return. And their cash flows are just more consistent, and they have been growing. Very, very consistent, very predictable. So I like Novo Nordisk. I'm going to put it on my watch list, but Eli Lilly would be a pass for me. Maybe in a couple quarters, they can show that, hey, their free cash flows are actually going to be much higher than $6 billion per year. That would change the valuation, but we're not even close. It's 76% price too high if I look at that factor. Go ahead, Scott.
I just have one comment on Eli Lilly that I found kind of interesting. A fact that I found interesting. Have you ever looked at the Vanguard ETF, MGK?
No.
So it stands for Mega Cap Growth. So I decided from the passive part of my portfolio, I buy into this one. instead of just the S&P. It's basically just like the growth portion. You can think of it like the growth portion of the S&P.
Mhm.
And so their top holdings, if you look at them, they the first company that's not technology, right? So the highest growth company that they have outside of technology is Eli Lilly.
Yep.
And it's after, oh, I don't remember. It's right before Google.
Yeah,
actually.
I'm showing the list. You can see on the screen, right? So here are the
Oh,
top 10
yeah, and
holdings:
so
Apple,
what I like about
Microsoft.
the ETF is it follows this growth-based benchmark. So any company, like even if it's big enough, if it's not matching the growth characteristics that they want, revenue growth, et cetera, it gets kicked out. So that's why I think Berkshire is not in here, for example.
Man, well,
But I just thought that was interesting that by far the company that with the highest growth that they had in healthcare is Eli Lilly.
very good. Yeah, I mean it's done great for the last year, and gotten it done for the last 5 years. Very good.
Yeah, this is also how I invest in Meta and Amazon, et cetera, because those are all in here. And so I do have Tesla separately, but that was kind of an accident. My plan is to sell it, to sell my shares of Tesla, and then just buy back into this.
Yeah, it looked like it's grabbing quite a list, right? Like 70 of the top stocks, including micro. You even got a little micro strategy in there. And then you got some big names. Airbnb's in there.
I think Uber is in here.
It should be because it's going to be in here, I would imagine. Here's Uber. And you got a good selection. Just as we get down the list down here, the percentage owned is a little bit low. You got a little bit of dogs in there, like Boeing Company, but as they get smaller, its position gets smaller in that stock. Yeah. So Visa's in there, Google's in there. I'm surprised that Visa's ahead of Google because Google has a much larger market cap.
I was surprised too, but then you think about it, it's because there's two classes.
They're splitting them.
They have
That's
to,
it.
to combine both of those.
So
and then
yeah,
it's actually like by Amazon, it's about the same as Amazon.
if you add these two, you're up to about 5%, which is, and then it would put it into the
Between
list.
Amazon and Meta.
Yeah, that makes sense now. Okay, that makes sense. Yeah, I mean, this is the ETF world, especially around the S&P. Needless to say, it's worked for the last 5 years. If that was kind of a set it and forget it kind of strategy, if for a passive investor or a smart investor, frankly, you can put it in there and then you're good. Yeah, so good one. All right, so I will note that I want to follow Novo Nordisk, and now we can talk about Disney.